But anyway, this is how you can double your money within a calendar period and still have some losses and not have to do this every day. Not have to put the trade on every day. You guys know we're not going to put this trade on every day due to how we manage the risk. Once you understand how to put the trade on at a high level, then you're going to have to understand how to read it, because reading it is going to tell you when you need to do things like adjust it, and you need to be able to adjust it at a very high level. And we talk about how you should be able to do that in the 1DT course, and how you should be able to do it in the adjusting course that we just recently came out with. You also, I want to talk about being aggressive but calculated aggression. How you can double your money or go broke using this 1DTE strategy. Obviously, we're trying to put framework around the 1DT strategy that you shouldn't go broke. You should say uncle when you're down 20%. We've updated the course, and we said, okay, to avoid big losses, because it's going to be times where the market's going to win and you're just not going to have the odds on your side anymore. So you have to say uncle, and ideally you want to say it around that 20%, if not less than that, or lower than that, if I should say, because you can come back very quickly with this type of strategy. This 1DT strategy, the way we do it here at Dorian Trader, is darn near like a day trade. It's darn near like the 0DT strategy. It's not exact, but it's darn near, meaning that you can make just as much with the 1DT strategy as you can with the 0DT strategy, the way we structure it here at Dorian Trader. We put it on at a certain time, and we're trying to get out of it at a certain time. We're not trying to spend a whole day, even though this is a 1DT trade. We're not trying to spend a whole day in the trade, because the longer you're in the trade, the more risk is associated with the trade. You want to be able to put it on at a very strategic time frame, and you want to be able to get out as soon as you can once the market opens. Okay? Here at Dorian Trader, we want to be in the trade for no more than 45 minutes of market time. You'll learn what that means in the course. But what I want you to understand now is that how we set it up, and then how you could try to double your monies within a calendar period. And I'm not talking about double your monies overnight. I'm not talking about double your money in a month. I'm talking about in a year. Right? So if you're going to double your money in a year, you're going to have to average about, I think it's about 6.5 or something like that percent per month to be able to hit 100% in a year. And that's definitely doable with this 1DTE strategy. And so the way we set it up is that we start off by checking what is the economic data coming out the next day. If it's some data that we do not like or care for, we're not going to do the 1DT strategy, because the data could cause the market to move bigger than what we want overnight. What's very interesting about this trade is that you have that overnight risk, and that overnight risk gives you a little bit more juice, a little bit more premium in the options because of that risk. So that's kind of puts it on par with the 0DT trade premium wise and possibility wise. But it's still less risk gamma rise than a 0DT trade. The 0DT trade has the most gamma risk, meaning that the rate of change of delta, the faster that delta is changing for you. With the 1DT trade, it's at least half of what the 0DT trade is. So it's less gamma risk. Is it times that the 0DT trade is better to do than the 1DT? Yeah, and we experienced that this year so far when we've had these big overnight moves, and we've had them for, it felt like, for 2 months at least of this 4-month year. Right? I know we're on 5 months now, but we're early in the month. The zero has been less volatile because of we've had so many big overnight kind of moves. But things are settling down, and now you can pick and choose your time. Only big overnight thing we're going to have now, in my opinion, is the normal type of stuff, right? The normal type of data that we try to avoid. So that's why we check that first. And then if we get some type of China deal, I think the market is going to love that, and we might see some type of overnight big move, right? 3-4%. The more we go up, and as we do this, as we discuss right now, this The market's been up 9 straight days. It looks like it's going to end that today, but it's still 15, 20 minutes left in the day, and so it could gain some momentum and go green again. I wouldn't be surprised if that's the case. The 1DT trade strategically right now is back in play, but you once again still have to worry about that China deal, because that's going to move the market in a big way to the upside. I don't think we have a big move to the downside in store outside of a normal type of 2%, 3% type of move over a couple of days. I just don't think it's in the cards right now. It could be if we keep going up every day, and that's just a normal type of pullback. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. But before you can think about doubling your money, you have to know the process, right? So you look at what's coming out the next day, then you look at the VIX rule of 16. So just to give you a gauge, so right now this is 23.28. So what you want to do with that 23.28, you want to divide it by 16, and that's going to equal about 1.45%. And this is the 2 standard deviation percentage move. It's about 1.45%. And so keep that number in mind, because we're going to revisit it. The next step you want to do is go into the 1DT. You want to pick the 1DT with the SPX. You can do this with the ES as well. I'm demonstrating it, and we're going to do it in the SPX. We're going to take the straddle price. The straddle price is just giving you the back of the envelope type of number of your 1 standard deviation move, or your 1 expected move. Right? And that's the platforms. If you're trading on a platform that specializes in option trading like Thinkorswim or TastyTrade, this is TastyTrade obviously, the expected move is saying 43. The straddle is saying 45. So I'm just going to round it up, and I'm going to say 46 times 2. That's going to give us a 92. So we said 46 times 2, that would equal 92. You can even make it to 100 if you wanted to make it easy math. But what you're going to do is add and subtract that from the current price of this 56.57, 56.58. And so I'm going to add that to get the call side, and I'm going to subtract that to get the put side. If we get that 92 and we say 56.59, and that's going to take us to the 57.51 on the call side. So let's just say 57.50. That's a 4 delta. We're going to do a 20-point wide spread when we're doing our 1DT trades. And then we're going to take the 56.60 minus the 92, and that's going to take us on the put side to the 55.68. 55.68. So let's just go with the 55.65, and we're going to do a 20-point wide spread. And so that's giving us 150 at this point. That's a lot of premium, right? That's a lot of premium for nothing really coming out tomorrow that we have to worry about. Definitely a 2 standard deviation move from both sides. And so we can make it further away. What are we worried about tomorrow? Are we worried more about the call side or the put side? Well, the call side is a 4 delta. The put side is an 8. So what if we move this put side down to a 6 delta and see what it looks like, and we do a 20-point wide spread? But that's still giving us 135. Yes.
Quick question: why 20 points and not 50? Because I know in the course, Dr. Meadows uses a 50-point spread.
Yeah. So we do it a little differently with the 0DTE. Excuse me, with this 1DTE trade, we want to keep the width no more than 20, or exactly 20 to start it off with. Sometimes we'll deviate, but most of the time, 95% of the time or more, we're doing the 20-point wide, because the way we set it up is that we're allocating 5K to each trade, and we're using, let's say I'm using 5K on this trade, well, I'm going to initiate with the 1DT trade using 2K of that 5K, and then we have the ability to adjust. So when we adjust, we could add another contract, which would take that 2K to 4K. So that's doubling your contracts, right? And that allow you to make a pretty substantial move. And then we have another type of adjustment where we go from 20 points wide to 10 points wide, and that allow us to use up the additional 5K and have 5 contracts. 5 contracts, 10 points wide is the 5K if we have to adjust. So we talk about this in the course, is that you're setting yourself up based on what we just did right now, doing the VIX rule of 16, doing the straddle price, putting on the call side, putting on the the put side based on 2 standard deviations away if you can, right? And you have been able to do that recently due to the higher implied volatility. But that doesn't mean you're going to stay right there just because you're 2 standard deviations away. If you can go further, then that's what you would do. And so that's what we're doing here, Fritz and everyone on the call, is that we are trying to determine which side do we deem has the most risk. And so
Put side.
I think the put side today, not
I put this on at 5550.
you put it at 5550. Okay. So I think the put side has the most risk too. That's why I want to move it. But maybe the call side has just as much, especially if we get an overnight deal. I don't think we will, but if we do, this will give you some
And I
room.
looked at that at 9 days up and 1 day down, little bit down. It may go down some more.
It might, yeah, we might continue down tomorrow, or we might return back to going up. But are we going to go up more than 2 standard deviations? I don't think so. I think we need a bigger catalyst, and maybe we're going to get some news this week. Maybe we get a deal from India. Maybe we get a deal from Vietnam.
And I saw the next little blocking point for the up is at 725, 720. So that's why I like where you were up there.
Okay. All right. So yeah, so I like that trade for tomorrow as well. And so this, if I wanted to go a little further, like what Susan just talked about, and I did a 20 point wide here, that'll still give me 120, and that's 104 points away at the on the put side there as we kind of fall a little bit more tonight. And so I'm gonna go and put it in at 120, and that's gonna be my trade. And I'm not gonna move that call side, but I'm gonna put this in at the 1DT trade here and make sure I get this correctly. So there we go. And I'm gonna send that. We're going to let it play out for a second, you guys. It's about 8 minutes before the market closes, so we're going to see what happens there. So what's going to happen here, you guys, is that let's just say that we start with 5K. Just do the math. I'm just doing it off the fly here. Say we start with 5K and we do this trade, I don't know, 3 times a week. Okay, and let's just say we average $50 each trade that we do. Okay. That's the net profit after fees and commissions. That's the 1% of the 5K. So if 3 times we do it in a week, sometimes you do it 5, sometimes you do it 4, most of the time probably 4, but I just say 3, right? So 3 times 50, that's going to equal 150. Okay. And if you average that 150 times 52 weeks, let's just say, right? If you times that by 52, that's going to equal 7,808. 7,800. You're not going to win every week, and you're not going to do it. You're not going to win every time, and you're not going to do it, 3 times 52 weeks. Maybe you might do it 4, but we're just averaging 3. So if out of this time you lose, $2,800 out of the trade, out of this time frame, you still have doubled your money. We just got filled as the market dropped a little bit more with 5 minutes to go. I thought we were going to go to the opposite direction. We're actually going down a little bit more, but that's fine. I like the trade. I think the market goes back up. If we're down 40, 50 points by the end of the session, the market goes back up tomorrow. I don't see a big down move, but we'll see if we have it. But anyway, this is how you can double your money within a calendar period and still have some losses and not have to do this every day. Not have to put the trade on every day. You guys know we're not going to put this trade on every day due to how we manage the risk. Once you understand how to put the trade on at a high level, then you're going to have to understand how to read it, because reading it is going to tell you when you need to do things like adjust it, and you need to be able to adjust it at a very high level. And we talk about how you should be able to do that in the 1DT course, and how you should be able to do it in the adjusting course that we just recently came out with. You also want to know how to read it at a high level so that you can know how to take it off. That's what we call the fourth step of this. How do you take this trade off? Do you take it off as an iron condor? Do you take it off as a put spread and a call spread individually? Or do you take it off as the short legs on the put side and the call side individually? How do you do it to make sure you don't get stuck in the trade and that you're exiting the trade the most effective way? We talk about that in the course. So you need to know these different things to be able to be solid on this strategy. I am considering doing a 1DTE cohort starting this month, later this month. If you guys think we should do it, let me know. But it's something that I'm considering that we will do on Thursdays. We'll have the cohort on Thursdays with the 1DT trade that we put on, usually going to be expiring that Friday, so we can kind of see it on the trading floor and things like that. But with that said, this is.
Ryan?
Go ahead.
Yes, you said you updated the 1-day course.
Yeah, I updated the 1 day course. It's just based on how to avoid a max or how to avoid big losses, and we talked about the 20% kind of down kind of threshold and things like that, because you can recover from that fast. That you guys can see here, it doesn't take a long time. I mean, it doesn't take a lot of work for you to be able to get to 100%. So it wouldn't take a lot of work for you to get 20% back. You only need to gain 25% back to be able to get back to even. And so this is how it works. So anyway, this is how you can double your money. If you don't know how to adjust high, or you don't follow that 20% rule, you can obviously go broke with that amount of money that you're using on the trade. And we don't want that to be the case.